All right, let's talk about Section 199A. For years, every tax pro out there had this ticking clock in their head, right? 2025. That was supposed to be the end of the line for the huge QBI deduction. And then, poof, the game completely changed. So today, we are going to deconstruct the technical mechanics of this thing. We're talking about a tax break that went from being a temporary fix to a permanent, massive windfall for pass-through businesses. Okay, so here's our game plan. First, we'll hit the big paradigm shift, how this thing got locked into the tax code for good. Then, we're diving into the absolute core of the calculation, defining what qualified business income, or QBI, actually is. From there, we'll navigate the two biggest hurdles, the SSTB limitation and those tricky wage and property limits. And we'll wrap it all up with what this permanent change really means for you strategically. To really get this, we have to rewind a bit. Section 199A was born from the 2017 Tax Cuts and Jobs Act. The whole point was to give pass-throughs a tax break that felt kind of like the new 21% rate for C-Corps. But because of how these laws get made, it had a built-in expiration date, a sunset, which was setting up this massive tax cliff. And then everything changed. So this timeline really maps out the whole journey. It kicks off with the TCJA in 2018. Then you get some crucial guidance from the Treasury and, importantly, this safe harbor, which is basically the IRS's way of saying, here's a clear path for your rental real estate to qualify. But the real earthquake moment here, the one our analysis hinges on, is this hypothetical 2025 law, the One Big Beautiful Bill Act, that slams the door on the sunset and completely rewrites the playbook. All right, now for the main event. Let's get into the engine of this deduction. What exactly is qualified business income? Because this number, this QBI, is the starting point for absolutely everything. So the definition comes straight from the source. Internal Revenue Code, Section 199A, C1. It says, QBI is the net amount of qualified items from U.S. trade or business. Now, two words there are absolutely critical. First, net, meaning this is after you subtract your relevant business deductions. And second, U.S. business. This is strictly for domestic operations. Now, the code is just as clear about what's not QBI, and this is where a lot of people get tripped up. Look at these carve-outs. Capital gains, investment income, gone. The whole idea is to reward active business, not passive investment returns. And here are the two big ones. Reasonable comp for S-Corp owners and guaranteed payments for partners. They get pulled right out of the QBI calculation. That's huge. And you can see that exact principle right here. Let's make it real. The S-Corp owner, they've got $250,000 of income, but we have to subtract their $100,000 W-2 salary. That leaves a QBI of $150K. Same story for the partner. They start with $200,000 from their K-1, but you pull out that $50,000 guaranteed payment. And what are you left with? $150,000 in QBI. The 20% deduction then applies to that final number. Okay, now we've hit our first major hurdle. For your higher income clients, this is the big one. It's a gatekeeper that can literally zero out the entire deduction depending on what they do for a living. This is the Specified Service Trade or Business Rule, or as we all know it, SSTB. Honestly, for so many service professionals, this is the question. It's the whole ballgame. Once your income crosses a certain line, figuring out if you're an SSTB is the very first thing you have to do. And the code, right in Section 199A, D2, gives us a list. It's pretty straightforward. Health, law, accounting, you see them there. If you're on the list, you're an SSTB. Simple enough. But then there's that last one, the catch-all. Any business where the main asset is the reputation or skill of its people. Now that is a landmine. It's a deceptively broad category that can catch a lot of businesses totally off guard. So let's say you clear the SSTB hurdle. Great, but you're not out of the woods yet. For higher income folks, there's another set of guardrails we have to deal with, the W-2 wage and qualified property limitation. The whole point here is to make sure this deduction is tied to a business that has a real economic footprint. The thinking behind this is pretty simple, really. Congress wanted to reward businesses that are creating jobs, which they measure with W-2 wages, or are investing in the economy, which they measure by looking at qualified property. So if your income's high and you don't have enough of either, well, your deduction is going to get capped. So let's look at how this thing is actually built. Your final deduction is the lesser of two numbers, either 20% of your QBI or this special limit based on wages and property. And that second part is where it gets really interesting, because it's actually a greater of test. It gives you two different ways to try and qualify.
So here's how that greater of test works. You run 2 calculations. Test 1 is super simple. Just 50% of your W-2 wages. Done. Test 2 is a hybrid. You take 25% of those same wages, and you add 2.5% of the unadjusted basis, just think of that as the original sticker price, of your qualified property. A business with a lot of employees is probably going to love Test 1. A business with a ton of expensive equipment will lean on Test 2. And the best part? Your limit is whichever of those 2 numbers is bigger.
Okay, so this brings us to the final, and I think the most critical part of this whole discussion. Now that this deduction is permanent, the entire conversation changes. We're not talking about a temporary tax break anymore. We're talking about a permanent, strategic imperative. This quote just nails it. The mindset has to shift from sunset mitigation, which was all about planning for this thing to just go away, to structural optimization. What does that mean? It means we have to proactively design business structures to squeeze every last drop out of this deduction year in and year out.
And that requires some serious technical planning. We're talking about things like strategically aggregating multiple businesses together, basically letting them team up, so their combined wages and property can pass the limitation tests. It means walking that tightrope of S-Corp reasonable compensation, paying enough to be compliant, but not so much that you kill your QBI. And it means deeply understanding how this deduction plays with other monsters in the code, like the 163J interest limitation.
So here's the bottom line. Section 199A is not just some simple calculation you do at the end of the year anymore. It's a foundational piece of the tax code, and it demands proactive, structural planning all year long. For any of us advising past 2 businesses, getting a handle on its labyrinthine rules isn't just a good idea, it's an absolute strategic necessity.